We have now finished the last month of the Hebrew calendar, the calendar used by the Jewish people and early Christians, until it was changed to the solar calendar. As has been the case many times in the past, this last year in a 7-year cycle, the last month of this last year, and even the last day of this last year, had significant losses in the stock market and even the bond market. This last year of this 7-year cycle on the Hebrew calendar is called the Shemitah year. The 7th year has historically been a year of reset, of financial collapse for the Jewish people. Interesting how it is so correlated to the U.S. and world stock markets. This year, it even dragged the bond market down with it. Hi, I'm Ben Reppond. Today is September 27th, 2022. Welcome to my YouTube broadcast. Last week, when I did the video on the Shemitah, the last year of the 7th year cycle on the Hebrew calendar, I pointed out that we had a week left. And it's the 7th year, and it's the last week of the 7th year. And typically that is very significant, and somehow it has this significance with the stock market. So I pointed it out because their focus is primarily on the economy and on the markets. And I didn't know what was going to happen, but it turned out the week was a horrible week. And then as I look back, the last month, even 6 weeks, have been a horrible down period. And of course, we know the entire year has been a horrible down period. I'll get into some statistics later. But it played out. It played out the way I was suggesting it might play out. I didn't say this is going to happen. It's not like I'm, forecasting, but but it did play out the way it has played out in the past many times. How is that tied to the historic Shemitah year? I don't know. I really don't know. But it seems to be a period of collapse. And of course, we know that September is a month of collapse, and the month right next to it is also a month of collapse, and that's a month of October. So we're in this period of decline, and the market cannot seem to get up. And what's worse than the stock market is the bond market. And what that means is portfolios, 60-40, buy and hold, asset allocation, balanced portfolio, that sort of thing, they are collapsing. And when I say collapsing, I don't mean going off a cliff. What I mean is they're just sliding down and down and down and down to the point when people look at their portfolios, they realize, wow, I'm down a lot. And I talk to a lot of people who tell me that. And it is common that portfolios of the people I talk to are down at least 20%. 20 to 25% is normal. That's a fifth to a fourth of your portfolio, of your money, of your retirement money. And each person is different, and I'm sure there are some that have losses of less than 20, and there are some that have losses of 30% or more. I know of that for sure. But I think in this 20-25% range is typical. That's a lot. And what caught people off guard was that this seemed to come out of nowhere. Many people, not everyone, but many people rely on financial advisors to help allocate their portfolios because it's complicated. It's something that is difficult for the average person to do. The language and the nuances and the risk, and it's just complicated. So people who have relied on traditional financial advisors, which is most people, have become very frustrated and even angry. I've talked to people who are quite upset that people, advisors who they've trusted to say, guide me, invest my money very cautiously. I want some growth. I'd love to keep up with inflation, but I'm not looking to make a lot of money. I just don't want to lose money. And those advisors have put them in investments that have gone down, and sometimes gone down a lot. And that has frustrated people, as I said, and made them angry that financial advisors who are supposed to know what they're doing have not guided them correctly. And it's been apparent to me, and if it's apparent to me, believe me, it's apparent to a lot of other people. I have access to information, and others have access to the same information. And that is, bonds were elevated. And they were elevated because interest rates and bond yields had gone down to the floor. Interest rates down to zero, bond rates down to around 2%. And they had nowhere to go but up. So, and as interest rates go up, bond yields track that. As they go up, bond prices and bond fund prices go down. So it was obvious when you saw interest rates at zero, at least it was obvious to me, that I'm not going to say they're going to collapse tomorrow, but I'm just saying there's a lot of risk in bonds. And I've been saying this for about a year and a half. And we took bonds out of our rotation, the portfolio combinations that we used. We took those out about a year and a half ago. And I've been saying it ever since. This is what we've done. You've got to decide for yourself. But there is a lot of risk in bonds, and there's a lot of risk in portfolios. Have you heard that from traditional financial advisors? No. They've been spinning it like this is going to go up, it's going to go up. If it comes down, it won't come down too far. It'll go on back up. Stay in your seat. Don't worry about it, etc. To go along with that, the stock market in 2021 was crazy elevated. I showed this on numerous charts showing how elevated it was. And it was overvalued. So at some point, when something is that overvalued, it becomes riskier and riskier to own it. And so what happened was, as risk entered the market, it came from supply chain issues and food shortages and the war in Ukraine, et cetera. And as interest rates started to go up to counter inflation, all of a sudden, the market starts to come down. Both the bond market and the stock market, they both start to come down. This was obvious. It may not be obvious to you because you're an average investor. It's not your job to know all of this, but it is the job of the financial advisors to know this. And they did nothing. They, as a group, from what I have heard, sure there's an exception here and there, but as a group, they all go along with the crowd. And the crowd said, just keep your money invested. Why? That is promoted by the mutual fund industry, which makes its money with you continuing to buy those mutual funds and ETFs. And they convince the advisors to just keep people invested, keep people invested. That's the narrative. And then the business schools teach that. All of them kind of feed off of the same information. But there are times where the market goes down a little bit and then it does go back up. So there are times where that kind of thinking is valid. There's also markets where interest rates are not at zero and stock prices are not crazy elevated. I understand that. So that the narrative used by the industry is partially correct. However, there are times it's not correct. And they don't tell you that. They don't say, I'm going to be right most of the time, but there's going to come a time when I'm not right at all. And it's probably we're just going to have to tolerate that, or whatever they say. They don't tell you that. You just have to find out by losing a whole bunch of your money. And I think it's sad. It's sad that that's a statement about the industry of which I'm a part. I want to show you a couple of videos that will summarize kind of where we are in the market, what has gone on this past week, the breadth of the losses that are out there. And it's two perspectives. One is from Bloomberg, one's from Yahoo Finance, both very well done. Shauna Smith from Yahoo Finance, just a very brief piece, does a really nice job of just summarizing the market, particularly for this past week. And then Lisa Abramowitz and Kailey Leinz Kailey Leinz from Bloomberg, they do a piece that's showing more about the types of assets, and again, looking a little bit longer for this past year. I want to show you both of those. They're very brief, but they'll give you a very good snapshot and an explanation of where we are for the year.
Dow, S&P, NASDAQ, all firmly in the red, right around the lows of the sessions here as we enter the final hour of trading. You can see the Dow now below 30,000. Looking at a 5-day chart, clearly it has been a brutal week for the markets over the past 5 days. Dow now off just around 5%. On an intraday basis, the NASDAQ falling below 11,000 as we've seen a lot of these larger cap tech giants here getting hit as we've seen rising rates. Obviously, the strong dollar here weighing on the broader markets. S&P falling well below 3,700, now on track for 3,600. We had Goldman coming out today lowering their year-end target on the S&P. So certainly some fear in the market action today. And really we could say that about the market action for the week. Over the past 5 days, you can see the S&P off just over 5.5%. I want to pull up the VIX, the fear gauge index, certainly very important here to keep an eye on. Spiking above 30 here really shows some of the fear out there in the market right now. Also, the 10-year yield pulling back just a bit, now off just around 2 basis points at 369. It did break top 3.8 earlier in the session today. Let's take a look at some of the sector action here because, again, we are seeing red across the board. Now, on an intraday basis, you're looking at energy off just over 7%. The XLE off 7%. Weakness in energy is a big story here in today's market. Consumer discretionary materials among the worst performers for the day. And then taking a look at the past 5 days, a very similar picture here. All 11 of the S&P sectors in the red. Energy by far the laggard, off nearly 11%. Consumer discretionary real estate here among the biggest laggards. Consumer staples, I guess you can say it's the best performer of the bunch. Is still off, though, just around 3.5%.
And what started as a mild sell-off this month has morphed into a deepening interest rate spread rout, wiping out virtually all of the gains that we saw in equities this summer. Kailey Leinz joining us, back for more fun. Kailey.
Well, Lisa, I'm not really sure it is a happy Friday, at least if you're invested in a lot of these different assets, and it really hasn't been a happy year. It seems really the only place anyone wants to go is cash or to the U.S. dollar, because certainly in the bond market, Ed was just talking about that higher rate story. We have to put this move in context. The move in yields marking a significant break of the long-term downtrend we have seen in rates. And when I say long-term, I mean 35 years. We have finally seen a shifting of the tides, though, as yields move up, price down. It seems like the great bond bull market is now firmly a bear one. And of course, those higher rates, as Ed was saying, have taken their toll on equities. He was talking about kind of tech as a basket, but imagine being a profitless tech company in this kind of environment. They have taken the most brutal punishment of all. A basket of those stocks down 54.5% on a year-to-date basis. That well outpaces the losses we have seen for the NASDAQ 100 or S&P 500, though, of course, those losses also are substantial. And it used to be amid all that carnage in stocks and bonds, you could at least count on some insulation in the commodity market. But as the narrative shifts from one of constrained supply to now weakening demand, that has changed too. Copper, for example, down 30% over the last 5 months. Copper prices down once again today, along with oil prices. You mentioned it earlier. We're looking at a 79 handle on WTI. So you can't buy the commodity market, you can't buy the bond market, you can't buy the stock market. I guess that leaves you with the U.S. dollar and cash. Lisa.
Very interesting. As you look at these videos, very unusual. Everything is down. Everything, with the exception of cash and the dollar. So you have stocks, bonds, treasuries, corporate bonds, high yield, high quality, commodities, precious metals, all down. Normally, one of these or some of these assets are going to be up. But all the sectors and all the asset classes, except the dollar and cash, are down. And even this last month, even energy was down significantly. In our own allocation this year, we have been defensive almost the entire year, most of the year. We had a couple of exceptions, I believe, in the month of March and in July, where the market had a little bit of an upward trend, and we got in and participated in that. But most of the time, we've been out of the market, either completely or fractionally. Earlier in the year, we were used just a fractional allocation to some defensive assets. But we could see that that was not working, so we abandoned the use of even a fractional use of defensive assets because none of them seemed to be working. So, and I believe that was in April. So in April, when we got a defensive signal, which has been a lot, we just went to cash. And cash turns out to have been, and the dollar, turns out to have been a winner this year because the traditional assets were not. The next video I want to show you is Tyler Mathison on CNBC interviewing Jim Bianco. And again, very brief piece. And he talks about this being, it's an interesting phrase, the worst bond market in history. Now, we've had some bad bond markets because we've had periods where interest rates and bond yields have gone up very quickly. But his comment was the worst bond market in history. And of course, when that's combined with the stock market, that makes it definitely a bad bond market. So listen to this brief clip from Tyler Mathison and Jim Bianco.
Jim, always good to see you.
Good to see you.
I think anywhere you look, people are stunned by how much interest rates have risen this year. Are you?
Yes, and I came into the year bearish on the bond market, but yet the returns that you've seen in the bond market are the worst in recorded history. This is going to go down as the worst year ever to be a bond investor. And it's not getting any better. What you saw today in the UK was the biggest rise in their 5-year note in history. It was up 51 basis points, 0.5%, one instrument in one day, which is an extraordinary move. You're seeing interest rates all around the world moving up higher, and it has just been a sight to behold, even for a bond bear like me, to watch these kind of moves that we've seen in the bond market.
And finally, I want to play another short piece from David Faber, who is interviewing Art Cashin on CNBC. Art Cashin is I believe he's the director of floor operations for UBS. He has literally been on the floor of the stock exchange for, believe it or not, I believe 6 decades. So he is a wealth of experience and a wealth of knowledge. And they always seek out his opinion because I think over his lifetime, he has thought a lot about what goes on in the market and looks at patterns and has very, in my opinion, very good insights. And so he will talk about the deeper risk in the market, the risk next month, etc. So take a listen.
Art, what are you keeping an eye on? What's sort of foremost in your mind right now as you look at this market action?
Well, a couple of things. Some near-term support. We're right at it. 29.6 in the Dow and 36.80 or 85 in the S&P. David, I'm going to watch very carefully to see what happens as we get around 11:30 when the European markets are closing. Do we start to firm up then? Does that tell us that some of this is some systemic risk selling coming out of Europe? If we don't firm up then we know it's equally here in the U.S. And I think some of that may be, we've been talking about quantitative tightening. I think we're finally getting to the balance sheet. Not big, but it's beginning to show up around the world as a decrease in liquidity.
Yeah. How important is that? How closely are you sort of monitoring that side of things in terms of the Fed balance sheet?
It's tremendously important. The new British Prime Minister decided she wants to be Margaret Thatcher II, and She put out a new policy today that was a little bit disruptive. We're going to have a major election in Italy on Sunday, so we've got a lot of things coming up. And as you know, David, I do some cycle work too, and the cycle's telling me to be careful as we get into October, particularly between the 7th and the 14th, and watch out for possibly things heating up geopolitically, particularly in Taiwan. So we got a lot to look at ahead of us. It's important that they circle the wagons here pretty soon.
Our Cashin talks about the concept of decreasing liquidity in the markets. Liquidity in the markets often drives markets. And you may think it's something else. You may think it's the Fed or interest rates or earnings or something. There are many people who believe, who are market experts, who will say that liquidity drives the market as much or more than anything else. And our Cashin talked about it, of decreasing liquidity in the market. And what's happening, one of the causes of this is the Fed is selling assets into the market. So they are selling treasuries, and $95 billion worth of per month of treasuries, and mortgage-backed securities. So I believe it's 60 billion of treasuries and 35 billion of mortgage-backed securities. And what that's doing is sucking $95 billion a month out of the market, decreasing liquidity. And it's apparent from those people who look at the kind of the engine behind the scenes to see what's going on in the market. A lot of them are seeing this decrease in liquidity. And so one of the reasons, not the only reason, that the market cannot go up is that liquidity is being pulled out of the market, but the forecast of future liquidity is also being pulled out of the market. Okay, I want to give you the flow of funds report. This is where money is going. Now, for the past 3 weeks, if you've watched this, you know that I've said that money is going out of equities, going out of bonds or bond funds, and going out of money market. So I scratch my head and I go, I don't know where the money's going. Well, this week we have more of an answer on that. So again, no surprise, because the week was down. It was a down week, this last week of the Shemitah year. Conventional equity funds had an outflow of $5.9 billion. Conventional bond funds had net outflows of $8.4 billion, and money market funds had inflows of $31 billion. Well, those don't add up. Maybe these past 2 or 3 weeks, people have just been holding that cash that they pulled out of equity funds and bond funds, and now all of a sudden they're putting it in money market funds. I don't know. But you can see the direction is out of risk assets and even out of assets that are considered a safe haven like bonds. Even money is going out of that because people can see that interest rates are going up and the bond funds are going down. So the safest place is either the US dollar or money market funds. Now, as I give you this, no surprise, it's an unusual chart because the dots at the right side of the chart look at these 7 indexes in relation to their 20, 50, 100, and 200-day moving averages. So are they above their moving averages or are they below those moving averages? Usually it's a mixed bag most of the time. On rare occasion, they're all above their moving averages, but that's unusual. But it's also unusual to see them all below their moving averages. No surprise, the next to the last one is TLT, which is the 20-year government bond ETF, and it's way below its moving averages. So you have the Dow, the S&P, the small cap Russell 2000 index, emerging markets, developed markets, and of course, government bonds, and then the NASDAQ 100. So if you look at the 5 columns of numbers to the right of the names of those funds, kind of between the dots and the names, you will see 5 columns of numbers. Those are the percentages of gain or loss year to date. Well, see, to Friday, it said that's percent change. The weekly percent change, monthly, quarterly, and year to date. So a really good view of where are all of these relative to their moving averages, and how far down are they? So take a look at this. I'm going to refer to this later. The Dow Jones Industrial down 18%. The S&P 500 down 22%. Small cap down 24. Emerging markets down 26. Developed markets down 27. Government bonds down 28. And if you go all the way back to December 3rd of last year, government bonds are down 31%. Wow. No wonder portfolios are being crushed. And the NASDAQ 100, which was the darling of last year, down 30%. You take the S&P 500 and you break it apart into its component parts. You can see all of the sectors within the S&P. These are all equity sectors. And again, to the far right of the chart are the 20, 50, 100, and 200-day moving averages. Every sector is below all of those moving averages. The one that was a winner, at least up until this last month, was energy, the one at the very top. And it is the best performer year to date. It is still up 26, 27%, but it was up over 40%. And it has come down. This last month, it has lost 15% of its value, and this last week, it has lost 10% of its value. So energy that was once very in favor is now out of favor. And as the money came out of energy, it didn't help any of these other sectors either. It, again, based on the previous chart, probably just went into money market funds. So you see the XLE, which is energy, was up year to date 27%. And then it gets worse after that, going from consumer staples down 10% all the way to the bottom, which is retail, down 35%. Inside of each of these sectors are individual stocks, individual companies. So these are weighted averages in each of those sectors, but it just gives you one number to represent that entire sector, realizing that there are companies that are better than that average and worse than that average within that sector. This is a chart showing the S&P 500 for the last year. It's a weekly chart. One move equals 1 week. So if it goes up, that means the S&P 500 is going up, and vice versa. Then I put a black arrow showing the trend from the top down to the bottom, and you can see that the S&P 500 clearly has a downward trajectory, and that last line at the at the bottom right is a line that's not down 1 week, but that's a 2-week down line. So it was down last week, and then it continued on down this week, meaning this past week. I do a ratio chart showing the companies in the S&P 500 that are growth companies, and then those that are value companies. Those are the 2 types of companies. Growth companies focus on sales and revenue, and value companies focus on profit and earnings. And growth is the numerator and value is the denominator. When growth is in favor, this line is going up. When value is in favor, those companies that are more focused on profitability, then the line is going down. And you can see since late November of last year, so this is 10 months ago, that the growth has been out of favor and value has been in favor, generally speaking. And you can see that black line showing the trajectory of that ratio. The blue line that cuts between those is a 20-period moving average. And another ratio chart showing small cap stocks as a numerator, large cap stocks, S&P 500, as the denominator. So when this is going up, this favors small cap, smaller companies. And when it is going down, it favors larger companies. So you can see the trajectory for the past, and this is a 24-month chart. This goes all the way back to March of last year. So this is for about 18 months, small cap has been out of favor. But look at that part, the first part of the chart where it goes straight up, small cap was in favor. And then the weakness actually underneath the surface that most people did not see was that the market was actually starting to weaken in March or following March. And then it affected later on in the fall, it started to affect technology. And then in the beginning of this year, it began to affect almost everything. So it sometimes has its origin way back there, and this one certainly did. Getting away from the ratio charts and the comparative relationship into an absolute chart. So this is the 20-year government bond. We've talked about it before. 20-year government bond, TLT, ETF. And you can see in this past 30-month period, on the left, the black arrow shows the downward trajectory of bonds. This is how far back the weakness had actually begun. And then you can see going back to beginning of December of last year, so this gets us to about 10 months of data. Look at the trajectory of bonds on the far right. Definitely a downward trajectory, and it goes down and down and down. And the further down it goes, no matter how fast it goes down, traditional financial advisors don't touch it. They just leave it in your portfolio, and government bonds are part of most portfolios. Sometimes they're intermediate term, sometimes they're long term. But they both move in a similar trajectory. And in this 30-month period, down 2 significant periods. And the traditional philosophy is just let it collapse, let it go to the bottom. Wherever the bottom is, let it go. Boy, I don't believe in that philosophy at all, but I know it's common. And then gold, this is a 48-month chart, so over half of this chart, you can see that there is a downward trajectory on gold. Represented by the ETF GLD. And so gold is weak right now. And as I've said, this year, precious metals, bonds, commodities, everything, with the exception of the dollar and cash, has gone down. And so there is no safe place to hide except the dollar and cash. And this is an 18-month chart showing the same on silver. This goes back to the summer of last year, so probably about 15 months. Silver has had a decline and is out of favor at this point, and well below its 20-period moving average. When we do a ratio chart of silver and gold, last week was very favorable for silver, and you can see at the far right of the chart, when you put on a ratio chart, silver sprung up very nicely. But then the ratio favored gold this week, and that line came down. But overall, you can see that for the past 18 months or so, silver has been out of favor relative to gold. Gold has been, it's been a better performer, but that's not the right way to say it. The correct term is it has lost less money. They both have been losing money. When I look at the volatility chart, the VIX, I've said that when this line is above 24, is a period of higher risk, particularly if the line is going up. And this past week, a week ago, the line crossed, the VIX crossed up above that number 24, and then this week continued its trajectory upward. And even during Friday, during the day, it was above 31. And you can see it, I mean, it's just spelling a period of higher risk. Of course, that'll eventually come down. We don't know when, but at this point, or as of the end of Friday, it was signaling a higher risk has entered the market. Asbury Research does their metrics called the Asbury 6, showing, measuring 6 different areas of the market and looking, are they positive or negative? And for, I think, at least a couple of weeks now, this has been negative and continues to be negative at this point. Asbury also does a comparative a relationship, a ratio of certain assets. So you can see, compare U.S. stocks to bonds. Both are obviously down, but for this time period measured, the bond benchmark, not the government 20-year bond, but the bond benchmark is down less than the S&P 500. High volatility or low volatility, in a period of decline, low volatility is in favor or has lost less. Large cap versus small cap, we've seen that. Large cap is in favor in all time periods measured. Again, lost money, but lost less. S&P 500 versus the NASDAQ 100. The S&P 500 has lost less than the NASDAQ 100. The U.S. versus developed markets. The U.S., this is interesting, the U.S. has outperformed developed markets and for each of the 3 time periods measured. And then in the fixed income or bonds, government bonds have outperformed corporate bonds, means lost less, believe it or not, and the short-term bonds have lost less than the long-term bonds. Okay, looking at the U.S. versus the world, it's not really a chart that says that it favors the United States very much. The countries that, relative to the United States, the countries that are doing better than the U.S. are, in all 3 time periods, Japan, Malaysia, Singapore, Mexico, Brazil, India, Russia, and Thailand. Was that the 8 names that you were thinking of? I don't think I was thinking of those. But isn't that interesting? Those countries have been, as an ETF, compared to our ETF SPY, have been outperforming the U.S. Interesting. The Buffett indicator, interesting shift here. We've seen the last 2 weeks that the Buffett indicator signaled overvalued. It has now signaled fairly valued. In other words, it's at a parity between the stock market and the economy. That ratio is fairly valued. It's not cheap, it's not expensive. It was overvalued the last couple of weeks. So this number, the ratio at the bottom, is 159% when dividing the market by the economy. That was last week 167%, and the week before was 175%. So it's interesting that as of Friday, September 23rd, that has come down and is now in the mode of fairly valued. So I'm always glad to bring you good news, and that one is good news. Gold and silver. We've talked about this in previous charts. Gold is down 2% for the week, and silver is down 3.6% for the week. and compared to the week before. And you can see that was evident from the charts on gold and silver that I showed you before. Do you ever feel like this? The stock market, the ride, crazy up, crazy down, and where does it end? We don't know, but I can tell you my outlook on the future of what it seems from here is generally negative. At some point, it will hit a bottom. I don't believe we're there at this point, but at some point we will. Excuse me. When we do, then the market's ready to take off again. But until that happens, what's happening now is it's just grinding its way down. This morning, as I was reading the news, I saw this picture, and it's a picture of the Hurricane Ian, which is developing in the Caribbean and is a threat to the southeastern United States. And I thought of it as a metaphor. It's a metaphor for the stock market, and more specifically for the financial advising segment of the industry, of the stock market. You see, in the stock market, there has been a hurricane coming. It's interesting that when interviewed several months ago, earlier in the year, Jamie Dimon, the CEO of JP Morgan, said in an interview, he said, it's like a hurricane coming. Like a hurricane. And as I saw this, I happened to remember that interview that he did and thought, that's what's happening. That's what happened last year. And many did not follow me at that time because I was on a webinar platform. But those who did follow me know that I was saying in the fall of last year, be careful, be defensive. Do whatever you've got to do to be careful because the market at this point is getting overvalued. So what I was seeing, of course, we operate our portfolios mathematically. So I'm not gonna, because I think of a hurricane, I'm not gonna make a change in a portfolio. But a lot of people don't do that. So when I saw this, I thought that it's so interesting that it reflects what should be happening. Because the weather people are looking at this data. It's run by formulas and algorithms, but it's converted to a chart. And they're looking at this data and saying to the people, particularly in the Southeast and in the state of Florida, you need to do something. You need to know this is happening. I translate that as get out. Lock your house up, get in your car, and get out of here. Go somewhere else. And that's what financial advisors should have been saying and should be doing to people who are invested. Get out. But they don't believe in that kind of model. They're locked into a paradigm of stocks and bonds, and they don't have an answer in their playbook for how do you handle it when stocks and bonds collapse together, which is what's happening. They just, I don't know what they do. I think they must meet, every Monday or something and come up with some sound bites to tell their customers, here's what you need to do or not do. But I can't repeat all the conversations I've had, but I can tell you it really frustrates people to be dealing with advisors who are more than willing to take their money and watch their portfolios collapse and do nothing to protect them. But this is an example of what happens when someone sees it coming that says, get out. Get out. And there's a time to get back in. It's when the storm is gone. That's the time to get back in. But when the storm is going like this, I just can't, it's hard for me to imagine the concept of just leave it invested and, oh, by the way, pay me a fee to tell you that. Thank you for watching. If you have comments or questions, leave them in the comment section below. I will try to answer them. And again, thank you particularly for watching this past week's video on the Shemitah. A lot of wonderful comments, and I appreciate those. Thank you.